All right. Wonderful. Good morning or midday. Happy midday to you, wherever you're dialing in from. My name is Jessica Amir. I'm joined by Charu Chanana and Redmond Wong. And Charu is going to open us up today. Charu, over to you.
Thank you, Jessica. So, yeah, let's start with some macro stories. What a big week that was the last week. Few key things that I think we plan to cover today would be what happened last week in the Fed meeting, what are we looking at this week in terms of the US CPI, and of course, lots of China chatter about reopening, which has been driving strong gains, but also a lot of volatility in the Chinese and the Hong Kong markets. So, let's kick off. And I think we had Powell deliver a really strong message last week. I think he managed to deliver that message on downshift in the rate hike trajectory. So we may be moving to a 50 basis points moves from the December meeting onwards. Market pricing is for just over 50 basis points right now. But the big news is that this downshift was delivered without further easing of financial conditions. I think he's made it clear that the focus really has shifted from here to the destination or the terminal rates and how long we are going to stay at that destination rather than the journey and how we get there in terms of what are the rate hikes at every individual meeting. So I think that was really key. We had NFP data on Friday as well, which was a little bit more mixed, strong headlines, strong wage growth as well, but slightly higher unemployment rate. Overall, I don't think that really changes a lot for the Fed at this stage. There's another labor market report. More importantly, two more CPI prints due before the next policy decision, of which, of course, one is due this week. We'll get to that in a bit. But I think for now, it's really important to continue to watch that data. But at the same time, understand that the Fed is already hinting at a higher terminal rate from what they had shown in the dot plot in September. So that upward repricing of the Fed path is happening. It will likely happen more if we see stronger inflation print this week. So I think that will really be important for the markets. But I think let's shift gears now and ask Redmond. I think that's really important to understand what really is happening in the treasuries. How are the treasuries adapting to this to a more hawkish shift from the Fed?
Thanks, Charu. Yeah, and the treasury market now, I mean, it's the last week basically. It's all it's all the story about the 2 year and the short-term yield it's a jump, and while the long-term yield actually is what the anchor. So and it's changed a little bit on Friday, and on Friday the 2 year yield actually down a little bit to 466 after they making a new high during the week, and 10 year yield and actually 30 year yield actually jumped 7 basis points on Friday, so the curve actually steepened on Friday. So I think that probably tell us that a lot of those pricing in additional rate hike probably is already in the market, and now is expecting about 65% chance of a 50 basis point rate hike for the December meeting. But the terminal rates, the big story, of course, is the terminal rates now is the market pricing in is around 5.1% next year. And so, yeah, I mean, it's the treasury market stabilized a bit, and also there was some other chatter about whether the treasury department will is considering to do some bond buyback. And at the moment, I think they have conducted some kind of survey with some primary dealer and asking them about the opinion. That is kind of debt management policy. The idea is to maybe issuing more T-bills short term, and then use the money to buy the longer end, and in order to stabilize a bit of the rise in the long-term interest rate. And also is and mainly I think it's more is to help to inject some liquidity, and because it's in the longer end of the treasury market, the liquidity has been drying up a bit, so that creates some concern. And Janet Yellen mentioned her concern several times, but that at the moment still pretty much premature, because that is still have, because the Fed is doing QT. So if the Treasury doing some things, that is actually contrary to that, that will be they need to give more consideration. But there's something bear watching, and it's still if any new development there, we'll update you.
Right,
Carol,
and
I think
of
get back to you.
course, yeah, of course, and that has serious, of course, ramifications for the equities market as well. But what's also going on, I think last week, the key story was these large-scale layoffs being announced by a lot of companies, but mostly in the tech side. And Apple warning on shipments of iPhones this morning, and then we also had Meta saying that they are laying off thousands there as well. I think these big names, of course, have a higher weight in the indices. But of course, let's ask Jessica what she's seeing in the equities market last week and what's the expectations for this week.
Yeah, great questions. I think so first of all, for those that don't know, NFPs means non-farm payrolls, and why bond yields are so important is because we know when yields spike, that causes a typical risk-off environment. So that's why it's just important to reiterate that and drive that home. And thirdly, it would also be remiss if we didn't say that bond funds are gaining a lot of interest from sophisticated investors as well. And we're seeing some investors also put a portion of their portfolio to bonds and or ETFs in the bond space, given the high yields that are on offer. But yeah, absolutely, Charu, great question there, just about what to expect from equities this week. So as you mentioned, there's been a lot of layoffs, and then of course we saw Twitter saying that they're potentially going to cut half of their staff. So I guess this gives rise to potentially what we're seeing in that mixed job report out from Friday. And I guess there's concern there that we could be perhaps a tip of the iceberg moment, that the unemployment rate in the US could continue to spike up. So given that the unemployment rate rose from 3.5 to 3.7%, I guess on top of that, now we're getting in the wake of quarterly earnings data that has been weaker than expected, number one. And number two, earnings are actually declining. So this is not really typically good for equities. But basically, what we're saying is, given that unemployment data is lagging, we could potentially be seeing a pickup in unemployment. So that's something to consider. When we are looking at this week, what to expect in fertilizers today, there's a company that we've been speaking about quite a lot called Mosaic. They are the first fertilizer company, I guess, to report. They are reporting today in the US. Later this week, we do hear from a raft of companies. We'll be watching Disney quite closely, given that they are a reopening proxy, and they've been doing really well on their new online edition, which is seeing a stronger than expected rise. But we have put in our note today what to expect and some key things just to sink your teeth into as well. But I think later on this week we will get Ralph Lauren. This will be quite an interesting but different company to watch, I guess. So there's lots on offer this week. But from an equity standpoint, I think the most important thing is inflation, Charu, and potentially how investors can be potentially hedging their portfolios if we do get a hotter than expected inflation read. So, Charu, what do you, if it would be, I guess, would it be okay if I just ask you what can we expect in terms of CPI this week? I think that's probably the most important thing. It could potentially be a make or break moment for equities here. So, just want to think we should focus on that. Over to you. What you think?
Yeah, absolutely. I think that certainly is very key. We have US CPI, we have China CPI, but certainly the US Fed path is highly dependent on that CPI print. We do get another CPI print just a day before the next Fed meeting. But overall, for this week, I think I'm particularly watching three elements in the CPI report. First, on the headline, whether we do go above that 8% mark. So the consensus is now looking for a 7.9% YOY kind of a print. But if we still, continue to see a higher than 8% kind of a number on the headline, I think that again would lead to a lot more uppricing of that Fed rate path. From here, we are already, like Redmond said, we are at 5.1% terminal rate in terms of the Fed funds futures. But I mean, I think because we don't have a real guideline as to what the Fed is thinking now. I mean, they did say 4.6% in September, but then again, later on they're saying that it's above that, but we don't have whether it's 4.75 to 5% or it's 5 to 5.25%. So it is really, there is some more potential to kind of see that being priced higher a little bit more if we do see a higher than 8% kind of a headline print. The other key things to watch in that report would be, of course, the core CPI. Consensus is looking at 0.5% month on month right now, but it really needs to get to around 0.2% kind of levels for the inflation to really come down to the 2% target that the Fed has. So I think the core measure, and then of course, I think lastly, the most key would be the stickier components, the shelter and the services costs. And if they continue to run higher, I think it is hard to expect that inflation will really come down to the levels that the Fed wants it to. So I think these are some key three things, that we need to watch. But also, I think important to consider how that moves the market. Certainly, I am actually, considering this as a potential for another leg higher for the US dollar, particularly because we are seeing this divergence in global central banks where the Fed continues to be more hawkish, but we have the other major central banks which have started to take a less hawkish path. Now it started with the RBA, then it moved on to the European Central Bank, then the Bank of Canada. Now last week we had the Bank of England as well as the Norges Bank, both taking a slightly more dovish turn there. So with that kind of a divergence, I think it clearly justifies further gains in the US dollar. I have written a piece on that on Friday as well, and you should find it in the research tab on the platform. So do take a look in that as well. But I think probably also very important to discuss on what's happening on the China reopening story. Redmond, also if you want to cover the China CPI, which of course remains quite a contrast to the US and the global CPI. Anything else that you're watching in China? The yuan, perhaps this week. Where does it go? It's all yours now.
Yeah, thank you, Charu. Yeah, and yes, I mean last week is first the story about some talk about the China reopening on Tuesday, and then is on Friday again that markets anticipations really heightened, and especially after that it was the former chief expert of the Chinese Center for Disease Control and Prevention, and Mr. Zhang, and he told an audience in the U.S. investment bank that the relaxation has already started, and then he cites some example of like the Beijing Marathon on Sunday, and the relaxing of PCR test requirement, and also he and so on, and so yeah, I mean. But on Saturday, the National Administration of Disease Control and Prevention, the officials there, they had a pre-scheduled press conference, and in the conference, they basically reiterate China's adherence to this dynamic zero COVID policy. So I mean, the rhetoric has not changed, the basic principle, the policy has not changed, and but that does not completely remove the hope for some relaxation and flexibility in the implementation. In fact, during the press conference, and those health officials also pledged that they will improve the implementation of the pandemic control measure and to avoid massive and protracted lockdowns. And so, and also another piece of good news is after the German Chancellor's visit to China, and China approved the use of BioNTech vaccine for foreigners living in mainland China, and that also stir up some hope that maybe China will allow some other more effective vaccine to be applied in China in larger scale later on. So all this pointing to maybe some flexibility. And I think that the reopening theme probably will still be around for some time, and then is and probably the market will trade firm on that as well. And then is on the economic data, yes, and we have I think the most important one from China to this week will be the credit data, the aggregate financing and new loan. And in September, the new loan, new renminbi loan, especially for corporate loan to corporate, was pretty strong. And so this month in October, probably it will decelerate a bit, and I think economists are expecting it to decelerate a bit after the big push for the bank to land by the end of the third quarter. And but basically the two, and especially Saxo, we watch the credit impulse very closely, and seems China's credit impulse has already bottomed, and we think that credit expansion will continue to be a supporting factor to risk asset in China, especially in equities. And on CPI, and yeah, it's a very different story in CPI and PPI in China. And in fact, PPI is expected to decline in October and expected to fall 1.6% year on year. That's mainly because of high base from last year, and because last year the material prices and energy prices were very strong. So, and then CPI also benefit from a high base last year. So CPI also expected to slow to 2.4%. So, and yeah, I mean, but I think the focus really will be on the credit data and the CPI and PPI, since they're quite benign, and probably will not be the focus of the market. Charu and Jessica, I pass it to you. Back to you.
I think maybe also worth touching upon commodities here, with likely more volatility this week because of this China reopening story. We had last week strong gains in industrial metals and energy, also cotton. I think gold also made quite a strong recovery after a slump, which was driven mostly by that more hawkish FOMC that we saw. But still, I think there's a lot more ground that gold needs to cover. It was rejected at that 1680 resistance for now. So it will have to take a few more attempts at that, and a test of 1700 really to reverse the current short-term downtrend that we have. But we still do think there's medium-term potential in gold and silver, especially as US yields top out, but inflation continues to stay higher for longer. But Jess, what are you watching in commodities? Maybe iron ore is something that would be worth watching this week, I guess.
Yeah, I think it's good to see that we've got a fair few people listening in. I think we need to remember what Redmond said, and what we've been saying kind of all ties in quite nicely. So the potential bottom, that's one thing. The second thing, keep an eye on these commodity moves, because remember, the market is forward looking, and the market is thinking that we could potentially see some positive signs, something being formalized potentially in China. So there's lots of speculation last week, this week, and then last week, of course, we had China's premier as well coming out as well. But before we get to iron ore, I guess the big news is the crude oil price. So the crude oil price is up 5%. So it's just scratching or chomping at the knees of the $93 level. But all in all, it's the oil price, the WTI price, is at its highest since August. So it rose 5.4% last week, and it's up 5% today. This also ties into a company to watch just quickly. So we've got Occidental Petroleum, who report later this week. pardon me, as well as Constellation Energy. So they're a diversified energy company, and they are in nuclear power as well. So they're two companies to watch, regardless of oil's move. Our house view is that we do see higher highs in the oil price over the medium to longer term, and that's on the back of EIA and OPEC saying there's not enough supply to meet demand. OPEC also recently came out, EIA rather, saying $1.5 trillion of investment will be needed to uh, but will be needed to be made to meet the current demand. So obviously there is a clear lack of supply and rising demand. Going to the iron ore price just quickly, the iron ore price is back above a key level. So this has supported BHP higher in New York and higher on the ASX, as they're also listed on both exchanges. So the iron ore price is currently up about almost 2% today. So it's at $87.30. So we haven't seen these levels for some time. That's something to continue to watch. Also, lastly, Charu and Redmond and everyone who's listening, also we at Saxo are keeping an eye on the copper price. The copper price is our preferred metal at Saxo. The copper price is up about 8% today. Last week it put on 7.5%. So the biggest copper company in the world is BHP. Rio Tinto also have some copper as well. And of course, there's Oz Minerals and many other companies around the world that you can look at. But all in all, the market is telling us that we're expecting further moves in commodities on the back of China. So this is something to keep in mind. But I'll shut my mouth there. I've always spoken for too long. Back to you, Charu.
No, I mean, I think let's just wrap it up on that note. I think we still will be publishing a Saxo Spotlight note, which you can read on the platform. We will cover all of this, a lot more, including what to expect from the US midterm elections, what that might mean for the markets. We will cover a quick preview of the UK GDP as well and what that could mean for the sterling. So do give that a read, and do not hesitate, of course, to reach out to us at Saxo if you need any assistance on your trading or investing journeys. That's it from us. Have a good day, good week all.